think about the wind names, uh, they're very interesting businesses in the sense that you can almost think of them as sort of the auto companies, maybe from the 80s and 90s business model. They're selling their turbines, at break even, maybe negative margin in some quarters, slightly positive margin, but then they've got these relatively big service businesses where they're taking care of all the turbines that are out there in the field, and those tend to be pretty high margin businesses.
I mean, it's going to be cheaper from Qatar and Russia if Russia can get it out. But with that being said, at current prices and what they've been in the U.S., it's very cheap. So even when you factor in the cost to for the longer voyages to Europe and Asia, it's still very economical. I mean, global gas prices in Europe and Asia, they're still elevated to reflect that vulnerability to supply risk, even though they've come down because Europe's storage is above 90%.
70 plus is a lot nicer than 60 plus, I guess. But, it really is difficult to gauge demand.
The key drivers right now are, once again, demand. And that's not really been a positive driver for oil prices. There's been a lot of worries around demand, especially in China.
When we talk about cycles, long cycles, we talked about the super cycle and commodity and what drove that, and that was the China growth. Okay, and I think we can all agree that has decelerated.
I think a lot of analysts on the street were expecting demand to be much better, not only in the first half of the year, but especially in the third quarter, which tends to be seasonally better demand. And I think what everyone is starting to realize is the picture in China may be changing structurally. I mean, the troubles that they've been having in real estate is, of course, very energy intensive. That really seemed to cool off. And this has a lot of implications for energy demand and for oil demand.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange. On the call today, we've got Salih Yilmaz joining from Cyprus, I believe. So, hey, Salih, thanks for joining. Swinging across the rest of Europe and the Atlantic Ocean, we've got Vince Piazza joining from our Wilmington office, and then we've got Talon Custer joining from our office in Princeton. Good morning, good afternoon, guys. Let's just do a quick check-in on the commodity complex. When I pull up my screen, I see that WTI is sub $70 a barrel today. Brent is in the low 70s. Natty gas is, at least Henry Hub here in the US, is a little over $2 per MMBTU. So Salih, let's come to you first. I imagine where we're sitting when the oil price here at the moment is a tad disappointing for folks in the oil complex. What do you read of the current market dynamics? What's going on in Libya? How's OPEC responding? Give us your read of the tea leaves.
Sure. So I think the key drivers right now are, once again, demand, and that's not really been a positive driver for oil prices. There's been a lot of worries around demand, especially in China. I mean, one of the biggest drivers in oil demand growth. And OPEC Plus and its current plans to bring some more supply back into the market. Of course, they've been keeping a tight grip on supply, and they've actually done 3 layers of big output cuts in the last couple of years. And their current plan was to gradually start bringing those barrels back starting in October. And the current outlook for the fourth quarter is that this remains a pretty well supplied market. I mean, I think a lot of analysts and perhaps OPEC Plus themselves were really hoping for a big uptick in consumption globally for oil in the fourth quarter, but that's not really certain as things stand. And then when we look at supply, we've had some robust growth from non-OPEC Plus producers, especially the US, but also places like Brazil and Guyana. So just the idea that OPEC Plus would start bringing output back into a market that looks pretty well supplied has been quite a bearish factor. And I mean, as you mentioned, Libya has been an interesting one because there's been quite a turmoil in Libya in the last week or so. And this was initially some news that was bullish for the oil market. I mean, last week it actually pushed prices higher. And what happened there was that there was this a political spat between the Western and the Eastern governments there. And the Eastern government said that they called for a halt to all production and exports from the country. And what we saw since then was halving of the output in Libya, which was quite significant. And of course, this was the initial bullish reaction that we saw in oil prices. But since then, there's been some news that the UN is pushing for a deal between these two rival governments. And there's been some news in the last couple of days that they might be close to reaching an agreement. And of course, this brings the possibility that 500,000 barrels per day of lost output may be coming back. So that also turned into a bearish driver for oil prices. So all of those combined, suddenly we had Brent below $80 a barrel, and Brent is now, as you said, below $75 a barrel now. So I think those are the key drivers. And of course, I don't want to talk for too long, but perhaps later on the call I can talk about what this might mean for OPEC Plus as it tries to decide on its next move.
Okay, let's circle back on that. Vince, let's come over to you. What do you make of the current oil price environment? Is this a price that the U.S. players are agnostic about? Are they excited? Are they a little disappointed with oil flirting with sub 70 here in the U.S.?
70 plus is a lot nicer than 60 plus, I guess. But, it really is difficult to gauge demand, especially demand when you already have a fairly well supplied market at this point. Also, you're coming into a little bit of the shoulder season as we start to think about winter and winter blends and demand for winter blends. We also starting to think about here in the U.S. Interest rate cuts as we're starting to see some issues on the macro side as well. So there is a degree of uncertainty. But most budgets are probably going to be underwritten at a 70 handle and a 3 handle on gas. Right now, balance sheets are in pretty decent shape. So I don't think anyone's really stressing right now about the oil price. In that 70 handle, it's more of a sweet spot for a lot of the E&Ps. It's not too high and it's not too low. It's in that perfect Goldilocks type of range. But, as we bleed down here and as we get into 2025 planning season for boards, I'm sure they're looking at this. What we have not seen is a lot of M&A activity since the major announcements earlier in the first half. So I'm sure that this price action has put people on hold for any major decisions. And also the FTC has put people on hold with any major decisions, just given how they have reacted to previous deals.
Normally, we think in the U.S. as Labor Day weekend as being a sort of barometer benchmark on kind of what's happening on the demand front. Have you seen any numbers out on that this year, and kind of what's your read on kind of where the U.S. Refined product demand is looking for the remainder of the year?
Yeah, I think in general, margins have come off for the refiners, just given the way, and in addition, probably export demand has been a little softer as well. So the demand side of the equation is always the hardest to gauge. And as we get into the third and fourth quarters, as we get into the winter season, we'll need to gauge much better where those numbers are. Same can be said, for natural gas. We're pretty well supplied there as well. We sort of came off the bottom here, sub $2, and we're looking a little better. So maybe for both commodities, we have a better backdrop, but it's really just more driven by demand than it is on the supply side. Supply side, it's easy to count. It's hard to count the various factors that go into the demand equation.
Talon, let's swing over to you on the gas side of the equation. I'm always curious, at $2 per MMBTU, or heck, even $4 per MMBTU, how does U.S. gas compare on the global marketplace compared with all the other big exporters, Qatar and so on? What do you make of the current gas price? What's going on with U.S. LNG exports? And give us a sense of kind of what the current status is of LNG export capacity here from the U.S.
Yeah, so I mean, it's going to be cheaper from Qatar and Russia if Russia can get it out. But with that being said, at current prices and what they've been in the U.S., it's very cheap. So even when you factor in the cost to for the longer voyages to Europe and Asia, it's still very economical. I mean, global gas prices in Europe and Asia, they're still elevated to reflect that vulnerability to supply risk, even though they've come down because Europe's storage is above 90%. Again, pretty well supplied, but have to factor in those potential geopolitical risks. So it's still very economical. U.S. LNG exports are flowing. They're going to grow a little bit. Some projects are delayed, like Golden Pass, may not start till the very end of next year, even beginning of 2026. So that prolongs, U.S. gas prices may not get that boost that they were hoping for earlier, but it'll eventually come.
I'm just looking at the screen right now. European gas is 36 euros per megawatt hour, which is quite elevated still compared with the U.S. Henry Hub gas pricing point. And there is some sense that it appears that there's some geopolitical risk premium still apparent there in that European natural gas price story. And I'm curious, Salih, to come back around to you, because it doesn't seem like the oil market is as fixated on geopolitical risk here at the moment as the European gas price is. And so why hasn't geopolitics played more heavily into the oil price here at the moment? And how are you thinking to bring it back around to OPEC like you suggested? How do they have to play their tapering decision given what's going on with the global oil market right now?
Yeah, I think the short answer to your first question is because we just have a lot of spare capacity. I mean, as OPEC and the wider OPEC Plus group delivered these output cuts, it meant that their spare capacity just built. And this spare capacity usually works as a cushion against any unexpected disruptions. So even in the case of Libya, I mean, even if Libya lost all of their production, which is 1 million barrels per day, I mean, just OPEC without the OPEC Plus members currently sits on about 6 million barrels per day of spare capacity, excluding Iran, which is exempted from the cuts. So they could easily come in if they had to and bring some barrels back into the market to make up for that shortfall. But of course, Libya is one of the geopolitical developments that we're seeing, and it is sometimes quite surprising to me as well that the geopolitical risk premium with everything that's going on in the world right now is negligible, because we also have the conflict between Russia and Ukraine, and probably most importantly, the Israel-Hamas conflict, which is in the Middle East, very close to oil-producing countries. But I think the main reason the market may have become perhaps complacent about these risks is that since October last year, we've had all these risks, but we haven't really seen any actual disruption to supply. So I think unless we see an actual disruption to oil supply and oil flows, the market appears to be okay to be complacent about the risks. But bringing this back to OPEC Plus and what they might do next, and the Libya developments were quite interesting in the last week, because we already knew before the developments in Libya that they're in a pretty challenging position, because the fourth quarter looks well supplied, as we've discussed, and bringing back supply into such a market would always be challenging, because the result would probably be a drop in prices, because inventories would probably be built, it would be a surplus in the market, and prices would fall. But Libya potentially losing 500,000 barrels per day or even more could actually give them a little bit of room to start bringing some barrels. So it would actually be almost the perfect excuse for them to go ahead. But as things stand, it looks like there might be a deal in Libya, which would bring that 500,000 barrels, a little over 500,000 barrels per day, back into the market. And just the news of such a deal was enough to push prices down in the last week. So, I mean, Libya potentially coming back, market looking to be pretty well supplied, and prices below $75 a barrel. I mean, OPEC Plus is now in an even tougher position, because if they want to put a floor into prices, if they want to stop this kind of downward spiral in prices, I think they might just have to extend these cuts and delay their current plan of starting to unwind cuts in October. I don't think they would deepen cuts as things stand, but of course that remains an option for them. But I think what we will see market position for and perhaps price for is a potential delaying of the outline that OPEC Plus has given us of gradually starting to bring back those barrels, because it looks like it's not just the time to boost output in October as things stand.
You know, one of the things I'm just looking at right here is the consensus outlook for oil and gas prices. So if you don't know this function on the terminal, it's CPFC Go, and you can look at Brent, WTI, Henry Hub on down the line. And so this is not the forward curve. This is looking across sell side commodity shops, kind of where they're projecting commodities will be. And so for 2025, it looks like they've got an average price target of 67, and for Brent, average price target of $71 and change. So, you know, a little less than where we are today, but give us your read on that, Salih. I mean, that's not a very optimistic view on where the commodity could go in the near term. And I do get this sense that a lot of folks on the street have flipped to be a bit more bearish on the commodity complex generally. What's your latest take on sort of what the fundamentals tell us about the oil market right now?
Yeah, I think you're right. I mean, that's the trend that we've been observing. And I mean, quite honestly, that's in line with how we've been seeing fundamentals shape up for the rest of this year and 2025. I think a lot of analysts on the street were expecting demand to be much better, not only in the first half of the year, but especially in the third quarter, which tends to be seasonally better demand. And I think what everyone is starting to realize is the picture in China may be changing structurally. I mean, the troubles that they've been having in real estate is, of course, very energy intensive. That really seemed to cool off, and this has a lot of implications for energy demand and for oil demand. So when you combine that with the robust growth that we continue to see in US shale, more and more fields coming online in Brazil, more fields coming online in Guyana, and kind of, I think, more people realizing that, as I just mentioned, OPEC Plus is in a very difficult position. And I mean, perhaps they're not going to start unwinding cuts this year, but of course, that's going to have implications for the internal politics within the company, because there are some member nations that are very eager to bring those barrels back. So I mean, maybe they'll delay this by another 3 months, but then when you look at the outlook in 2025, it's looking pretty similar. So will OPEC Plus be able to just continue to delay unwinding these cuts, just keep extending the current level of output cuts? I think they're going to find that very difficult. And this whole time, their plan has relied on demand just coming back very strongly and giving them that space, giving them that room to bring that output back. But it doesn't look like that's going to be the case in the fourth quarter. I mean, of course, it's going to be, as Vince said, we're going to be watching. I mean, demand is always very difficult to gauge. We're going to be watching what happens in the fourth quarter. But if we don't get a significant uptick in demand and a structural change in China once again, then it's very possible that the first quarter of 2025 looks very similar, and then they just simply cannot bring those barrels back, which again means potential trouble within the group. So all of those combined are I think, bringing those analyst expectations for price starting in the fourth quarter, but especially for 2025, down from the levels that we saw. And on this function, I remember seeing those expectations above 80 not that long ago, and we're seeing those numbers come down because of all of these developments in the last couple of months.
Vince, I want to get your read on this. When I hear Salih talk about China, do you get a sense that there's structural or secular kind of stagnation going on with oil demand from there? I just saw headlines the other day. I think electric vehicles or plug-in vehicles are something like 50% of new car sales. So you've got this sort of interesting shift happening in China, and you continue to see pretty strong output growth, I believe, out of the U.S. Shale patch. So how do you reconcile that? Have the U.S. producers kind of got the cart ahead of the horse here at the moment? And when you kind of wrap your head around what that supply-demand balance, at least at the global level, rolls up to, are you worried that there's too much supply out there right now?
So just counting molecules, right, relative to the demand cadence or the perceived demand cadence, I don't really get a sense for the delta in demand growth and where that would come from, right? So when we talk about cycles, long cycles, we talked about the super cycle and commodity and what drove that, and that was the China growth. Okay, and I think we can all agree that that has decelerated, but we still depend on a country like that size to provide that demand uplift. And if any of the other countries in that global demand picture sort of have even a blip on the downturn for demand, that tends to have a broader impact on those balances, on that narrative. And so I really don't get a sense for where that extra uptick in demand growth is going to come from to satiate that supply growth of all the molecules of both oil and gas molecules. I can account for better growth dynamics, better demand growth dynamics on the gas side of the equation because of the things that Talon has been mentioning, the LNG growth, the things that you all have written about in terms of AI, cloud computing, and a data center growth. So those are much more secular and structural. But on the demand side, from an oil perspective, I think I don't really see that major uplift that would provide that powerful catalyst that we had prior to during the last cycle. I consider these cycles very long and broad cycles, but it hasn't been there. India was supposed to provide that type of extra catalytic growth, but we haven't really seen that in the overall numbers for us. For us on the gas side, the conflict, Ukraine, Russia, that provided a little bit of an added growth for the gas side to help put more molecules in storage for the Europeans. You look at storage today, and we're well above 92% at this point. So they seem to be doing a much better job. Last summer, we were saved a little bit by flows into the Asia corridor to help them out as well. But for that extra growth in order to drive these commodity markets higher, it's been very difficult to see where that's coming from, although on a longer term perspective, I still think that there's much more demand growth on the natural gas side because of structural catalysts relative to oil.
Okay, let's shift gears a little bit. Talon, I want to come to you because you've got a note out last week, I believe, at this point, looking at some M&A activity in your space. So can you give us the latest rundown on developments there and how M&A is impacting kind of midstream gas and product pipelines here in the U.S.?
Yeah, so ONEOK made a few deals. That's what I wrote about. Consolidation has been happening for a couple years. We expect it to persist, and I think Energy Transfer still takes the cake as the most aggressive. But ONEOK acquired, or they merged with Magellan Midstream at the end of last year. They're acquiring for $5.9 billion GIP stake in OnLink and also Medallion Midstream. I think the main point to take away from it is Bakken diversification, right? ONEOK is mainly a Bakken NGL service provider, so this diversifies. The Magellan merger didn't make as much sense because it was disparate products. They focused on refined products, but these ones, the Medallion and OnLink, make a lot more sense. And in midstream, you want to integrate the value chain. So that means you can generate incremental fees along the way. So gas gathering and processing, you transport the gas, you transport the NGLs, you can fractionate it, and possibly down the line export it. But ONEOK lacked gathering and processing capacity in the Permian, and that's what OnLink gives them. So it really fills a missing puzzle piece, and it helps them get ahead of some recontracting risks that they were going to face. There's a lot of NGL pipeline build out, and by getting this gathering and processing capacity, it essentially fills a lot of the volume that they're going to need. Medallion, it focuses on crude oil, but it's a similar scenario where they're getting gathering and processing, crude gathering and processing capacity from Medallion, which can then drive capacity to two underutilized pipelines that they have in BridgeTex and Longhorn. So, M&A in this space is a viable growth strategy. It's the regulatory, political red tape. It's tough to build. It's tough to grow. So M&A helps cut some costs, fill some gaps in the network. So we expect it to continue. I don't know if anyone saw it. There was headlines today. It's just a rumor of news reports that Williams had approached Targa, which would have been a huge deal. Again, the marriage between them doesn't make as much sense because there's not overlap. But Targa has a very enviable network of the wellhead to water, the integrated value chain in the Permian that I was talking about. Williams is more, natural gas, Transco, Appalachia, and Targa is more Permian. But again, it's a lot of the consolidation. It hasn't been, the scale hasn't been like in Vince's space with the E&Ps. It's been a lot more smaller asset level deals with a few larger ones, like ONEOK Magellan from last year, and the Medallion and OnLink are $5.9 billion. But they acquired 43%, which was GIP stake in OnLink, and they intend to acquire the rest after this deal is completed.
Okay, very interesting. Just a quick bit of advertising. One is that Vince, Talon, and I, and our colleague Scott Levine will be in Houston next week. We've got a big event happening on Tuesday that looks at the intersection of AI and energy demand. If you haven't registered for that event and you want to come to it and say hello, it's a little bit oversubscribed, but ping us. We'll see if we can get you in. And then I would just flag that I'm going to be in New York, not tomorrow, but a week from tomorrow. So next Thursday, it's hard to believe, but Bloomberg Intelligence is having its 15-year anniversary party. And some of us have been here since the beginning or close to the beginning, some of us old timers. So anyway, if you're around New York on next Thursday and you want to say hello to me, give me a shout and we'll try to grab a coffee or something. And with that in mind, I want to ask a big picture question. So I was on a call early this morning with some colleagues of ours on our tech team. Mandeep Singh, Anurag Rana, who cover, the Microsoft's, NVIDIA's, the Googles of this world, the big hyperscaler names that are in the tech space. And I think we've already covered on these calls this idea that one of the constraints on the build out of AI is energy, and there's sort of a really great pick and shovel angle on thinking about how AI could drive energy demand. But the point of that call was actually not to talk about that, but to talk about how companies, regular companies, are using AI in their own businesses. So I want to come to each of you and just talk about this idea and see if you're seeing it on any of the earnings calls. So, Salih, we'll come to you first. I mean, I think the oil industry has often had supercomputers as part of their exploration initiatives. And so I'm curious, are you starting to see any of them talk about use of AI to enhance that production profile? Do any of your companies have a chief AI officer yet? That sort of thing. I'm just curious to get your read on that perspective.
So yeah, I mean, it's actually surprising how often the oil companies, at least the ones that I cover, have started talking about AI. Not so much the actually starting to use it, but I think when you look at the number of times AI is mentioned in the transcripts of some of the companies that I cover, it's actually quite a lot. And I think, there's two sides of it, and you've already mentioned, I think, both of them. Is one on the demand side. Of course, AI will need a lot more energy, and that's good for their revenues. But I think the other one is, I think they can use AI to bring cost cuts operationally, and that's not necessarily when they're out there exploring for oil, but also back in the offices. I think it was BP that was talking about using AI to replace some coders because they don't need as many coders anymore, and that apparently moves the needle for them. And I think the third point is what you also already mentioned. I mean, they've been talking about how AI could be quite instrumental in better exploration, basically, and getting, utilizing the data better and being able to discover more resources more easily and perhaps more often. So those are the three that comes to my mind that I remember being talked about in some oil companies' earnings calls. But generally, I would just say that, I mean, of course, I don't know how often it's being mentioned in other sectors. I mean, I bet it is being mentioned more and more, given it seems like the more you mention AI, perhaps the better the impact on the stock price. But I've been quite surprised at how often it's been mentioned in our companies.
Yeah. So, by the way, for anyone who's never done this, there's a function called DSCO. It's a company document search on the terminal, and you can pull up that function and just basically search every company filing. So transcripts, 10Ks, 10Qs, on down the line, and you can set it to filter for, say, the S&P 500, and just type, artificial intelligence, and it's like a crazy hockey stick looking chart. It just suddenly came out of nowhere. It's in all the calls, it's in all the documents. Every company's got to talk about this a little bit. So Vince, over to you for this idea. Are any of your companies actively talking about this, not from a demand perspective, but maybe how they're using it in their business, if at all?
Yeah, well, where companies in the oil patch uh, tend to view technology in two ways. Mostly it tends to view technology as a means to gain efficiency and productivity, a means to pull cost out of the ecosystem. And they also use technology to be able to, use game theory and look at certain areas where they wish to drill and explore and exploit. We have heard more and more of this conversation, but again, more and more from the perspective of the demand side, obviously, but also from the perspective of gaining the efficiencies and gaining productivity to pull cost out of their ecosystem, as opposed to more on what I call the offensive side of things, using it as a tool to exploit a resource base, which I think will come in the future. But the industry overall tends to view things from the perspective of productivity and efficiency gains more so than anything else.
Okay, Talon, let's come to you. Thoughts on AI's impact into some of the midstream and LNG names you cover?
Yeah, so again, the obvious demand impact, right, between the data centers and what gas demand that might bring for the pipelines, and that's showing up in almost all of the company's calls. The other angle, not so much, but heard it in the past, where AI can be used for fugitive emissions, maybe predictive modeling to try and detect areas that need repairs before something happens. So it's more things along that nature to boost efficiency, right? Because obviously not only is it beneficial from an ESG standpoint, that's more gas in the pipeline, that's more volume, more fees. So that's what it is on midstream. It's definitely from the efficiency standpoint to monitor their networks and address it before something happens.
Yeah, I'll do a similar read across in just saying there's like that interesting predictive maintenance angle. If you think about the wind names, they're very interesting businesses in the sense that you can almost think of them as sort of the auto companies, maybe from the 80s and 90s business model. They're selling their turbines, at break even, maybe negative margin in some quarters, slightly positive margin, but then they've got these relatively big service businesses where they're taking care of all the turbines that are out there in the field, and those tend to be pretty high margin businesses for all the wind names. And so maybe if you use AI, you can get sort of a slightly better advantage there. And we'll see how it unfolds, but I think at least for most of my names, the real exciting piece of it is the energy demand and power demand appear to be poised to grow pretty rapidly. And so they're not talking so much about how they're using AI in their own business, but how it's potentially going to drive demand for, whether it's gas molecules, solar electrons, or wind electrons. It seems to be that there's a real theme about that coming here over the next few years. So I think with that, we'll have to end the conversation today. I want to thank Salih, Vince, and Talon for joining. We hold these calls every Wednesday, and if you've got a colleague or peer out in the industry that you think would be interested, feel free to forward along the details on how to sign up and join us. And we look forward to talking to you next week. If you are based in Houston, please come and see Vince, Talon, Scott, and I. And if you're based in New York, try to grab us for a quick hello next Thursday as well. And we look forward to being in touch. Talk to you guys soon.
Thank you.
Take care.